In transit, it's a term that might sound simple at first, but in the world of accounting, it carries a weight that can significantly impact how businesses operate and report their financial health. So, what does in transit actually mean in accounting? Imagine a shipment of goods, carefully packed and on its way to your business. It's not just a box moving from one place to another, it represents money, resources, and the lifeblood of your operations. Understanding this concept is crucial for anyone stepping into the accounting field or managing a business. When we say something is in transit, we're talking about goods or funds that have been dispatched but haven't yet arrived at their final destination. This can refer to inventory on its way to your warehouse or cash being transferred between accounts. The reason this matters is that it directly affects how we record transactions on our financial statements. According to generally accepted accounting principles, or GAAP, transactions need to be recorded as soon as they occur, regardless of whether the payment has been received or the goods have arrived. This means that even if a shipment is still on the road, it needs to be accounted for. Let's break it down a little further. Companies utilize in-transit accounting to maintain accurate financial reporting and gain better visibility into their inventory levels. There are two main categories of in-transit items, inbound and outbound. Inbound in transit refers to goods that are on their way to your business, while outbound in transit refers to items that are leaving your business. Keeping track of both types is essential for accurately recording costs and revenues, which ultimately impacts your bottom line. Now, it's important to clarify what in transit does not mean. It doesn't imply that the transaction is incomplete or that the assets are lost. Instead, it signifies that the transfer process is ongoing. This is a critical distinction because while items may be in transit, they still need to be accounted for accurately in your financial reports. This ensures that your balance sheet reflects the true financial position of your company. The term itself has a rich history, dating back to the 18th century when businesses began to recognize the importance of accurate bookkeeping. Merchants and traders relied heavily on this concept to track their goods as they moved across borders. As technology evolved, so did the methods of tracking these transactions. Today, businesses have access to sophisticated software that allows them to monitor their in-transit items in real time, providing a level of visibility that was once unimaginable. So, how does this all relate to accounting? First and foremost, it's about accurately accounting for assets in transit. When goods are shipped, businesses often record them at their market value rather than the purchase price, especially if they're crossing international borders where currency fluctuations can come into play. This practice ensures that your financial statements reflect the current value of your assets. Next, there's the recognition of revenue. Businesses typically recognize revenue upon delivery, but what happens when goods are still in transit? In such cases, the sale is recorded as deferred revenue until the customer receives the item. This practice ensures that revenue is recognized accurately in alignment with the delivery of goods or services. Documenting expenditures while items are in transit is another critical aspect. Shipping costs, packing materials, insurance fees, and customs duties all need to be tracked meticulously. These expenses must be recorded to ensure that your financial reports accurately reflect the costs associated with your operations. Tracking valuable assets while they're in transit is equally important. If a business is moving high-value items, it's crucial to monitor their condition and any changes that may occur during transport. This helps in accounting for any losses or damages that may arise, ensuring that your financial statements remain accurate. Reconciling accounts while items are in transit can be a challenge. It requires thorough documentation of all expenses related to the transfer to ensure that everything aligns once the invoice arrives. This meticulous attention to detail helps prevent discrepancies that could lead to larger financial issues down the line. To illustrate the significance of in-transit accounting, let's consider a few practical examples. Imagine a company that has just placed a $100,000 order for inventory. The moment that shipment leaves the supplier, it must be recorded as an asset on the balance sheet. When it arrives, that value is re-recorded to reflect its arrival. This practice ensures that the company's financial statements accurately reflect its assets and expenses. Another common scenario involves transferring funds between accounts. When you move money from a checking account to a savings account, those funds are considered in transit until they reach their new destination. Accountants must track these transactions diligently to ensure that everything is recorded properly. Prepaid expenses also fall under the in-transit umbrella. If a business pays for services or supplies in advance, those funds are technically in transit until the goods or services are received. Tracking these transactions is crucial for managing cash flow and ensuring that expenses are accurately reflected in financial statements. Now, let's talk about the benefits of keeping track of in-transit items. For business owners, having visibility into what is in transit allows for better planning and optimization of operations. It helps avoid unnecessary costs associated with excess inventory or emergency orders due to unexpected shortages. Knowing the status of shipments enables proactive management of delays or potential issues, which ultimately leads to improved customer satisfaction. However, tracking in transit items isn't without its challenges. Inaccurate forecasting can lead to resource shortages, compliance issues can arise if proper documentation isn't maintained, and the risk of theft or loss increases when goods are in transit. Additionally, unreliable carriers can lead to unexpected delays, and damaged stock can negatively impact customer loyalty. To effectively keep track of items in transit, businesses can utilize a variety of tools. Automated tracking software provides real-time updates on the status of shipments, while cloud-based accounting platforms allow for easy access to financial information from anywhere. Manual tracking systems can work for smaller businesses, and document imaging systems help maintain organized records of all transactions. In conclusion, understanding the concept of in transit is essential for anyone involved in accounting or business management. It's about more than just tracking shipments. It's about ensuring that your financial reports accurately reflect the movement of assets and funds. By effectively managing in-transit transactions, businesses can gain valuable insights into their operations, maintain accurate financial records, and ultimately drive better decision making. So next time you hear the term in transit, remember its significance in the world of accounting and how it plays a crucial role in the financial health of a business.